Okay, so today I want to show you this. And this is from a company called Dimensional. And while, because of regulation, I have to make really clear this is clearly not a personal recommendation to use any of their funds, even though as an advisor, we do have access to their funds and full disclosure, we do use them in our portfolios. They're typically, Dimensional funds are only available to advisors or institutional investors. But this is their matrix book. And the reason why I kind of want to talk about it is I think it's a really good resource for kind of putting in a bit of perspective about the markets and hopefully might make you a better investor to be at least aware of this type of information. So who on earth are Dimensional? Well, look, founded in 1981 by David Booth, who's kind of a huge name in the world of finance. They're driven by an evidence-based approach to investing, as in what does the data tell us about how to invest, how can we apply it? And it's been created by people on the board from the likes of Merton Miller and Eugene Farmer, who are huge names in academic finance. Anyway, this year they provided the Dimensional Matrix book, which is an incredible source of data. And on occasion, if needed in a client meeting, just when we need a bit of context as far as kind of the historical figures, it's useful to kind of bring out, provide a timely reminder on, okay, what's the purpose of the investment? Have the objectives changed? Has what we want to achieve changed? And while of course, look, the best advice can often be stick to the plan, but it's important to talk it through and to look at the big picture. So this is the UK version. There is a US version which is available broadly online, so I put that in the description. So you'll see this quite like intimidating triangle thing when you're going through it, but it really is super simple. So let's go through it. Okay, so this is on kind of one of the first pages, and what we're doing is when we have a look at sort of the years down on the right hand side of the triangle, and that is sort of the first year that we're going to look at when we're locating the data, and on the left hand side is the kind of the last year. So if we just focus on the one that's highlighted, what this is showing us is this is for the Dimensional Small Cap Index. So potentially we could use that to answer the question of what's the performance of small cap broadly been over a period of time. And we'd go, okay, from 2002 to 2006, and we can have a look at kind of the years 2002, 2002, 2002, 2003. And what it is that bit that it's highlighting, so 2002 to 2006, that is the annualized return over that period. So this data is basically then showing us, okay, that is the annualized return from 2002 to 2006. And you can see the annualized return kind of as we go down. So let's go down a little bit further. So 2007, 2008, 2009, clearly, because that's the great financial crisis, not a great time for small caps. So we can have a look. It goes minus 7.8 for 2007, minus 25.8 from 2007 to 2008. And you can see the annualized return here is minus 5.8 from 2007 to 2009. And actually things didn't quite turn positive till 2010. So had you invested at 2007, you would have been pre-adjusting for inflation underwater till 2010. Okay, there is a huge amount of data in here. So let's go over some kind of like typical questions that frankly we've all been asking over this period of high inflation. And I'll go over bit by bit and use this data. Okay, so why don't we try one of the first ones was, does globally diversified investing work? And I'm going to go to the MSCI World Index. I'm going to go inflation adjusted. So if I was talking to a client and we would say, look, the only way to really judge real wealth is wealth adjusted for inflation. So everyone's saying, oh well, cash is safe. Well, actually, if we have a look over the long term, cash actually compared to inflation, when we adjust it for inflation, tends to lose value. And if your wealth can't keep up with inflation, then you're basically going backwards. So let's have a look at globally diversified investing. So this index is the MSCI World Index, which is broadly a very good proxy for global stock markets, and it's inflation adjusted. So we have a look on the left-hand side. This goes into what was a really challenging year for global markets, which it starts at 1970, the data. Now the 70s was a dreadful time for stock markets because inflation was incredibly high. And actually, if we flip it to the other side where we just have a look at the non-inflation adjusted, you can see there isn't actually much red apart from 1973 and 1974. The big picture is non-inflation adjusted. Actually, the market created a nominal positive return. The return wasn't fantastic for some of these years, but it did create a nominal positive return. But when we adjust it for inflation, because inflation was so high in the 70s, you can see that, if I have a look at 1972 and look at the annualized return, the year 1972, really strong return at 24.8. as we go down, you can see actually the annualized return all the way till 1982 was inflation adjusted negative. So that's basically a 10-year period where when we adjust for inflation, you would have been underwater. So somebody could very fairly say, oh, well, actually, do stocks work as a long-term inflation hedge? Well, if we were to have a look at that, even looking from 1972, which is clearly a horrific time to consider investing, as we start to go further out, we can start to see the annual return climb. And even though that was a dreadful time to start, when we get all the way up to 2004, 2005, you can start to see that we're getting to nearly 5% annualized, which, considering how bad the initial period was, actually doesn't sound that bad. That's after inflation, by the way. And when we look at the Credit Suisse data, what is the stock market average return since 1900? It's about 5.5, I think. I'll put the data on here in case I get that wrong. That's from memory. Now, clearly, if we have a look at that in a period where the market's performed really well, say, for example, 1981, you can see as we have a look at the annualized return from 1981, it's fantastic years, 8.6, 16.2, 20.7, 22.1. Do you feel secure in your financial future? Or perhaps you're just telling us, well, it's telling us that cyclically, clearly markets have periods where they perform really well and periods where they can perform not quite as well. But over the longer term, they are a great hedge against inflation. Okay, well then what about cash? Interest rates on cash at the moment are higher. Why don't I just move to cash because it's a known return? And we've got a good answer here. In UK 1-month Treasury bills, inflation adjusted. So this is on page 17 of the UK book. And why this is interesting is that 1 month the UK Treasury bills are a decent proxy for cash. So they'll give you a good idea of what you could get if your money was to go into a bank account. And we have a look at the inflation adjusted figure here. And you can see in the 1970s that it was pretty dreadful. If you started in 1970, it would have only come out with a positive inflation adjusted return in 1986. And at that point, you're still only up to a positive return all the way till the 90s of kind of 0.7 to 1.5. Have a look. I think this is definitely the most important bit. If we have a look at the interest rate environment that we've come from the last sort of 12 years or so, you can kind of see the absolute sea of red really here on the right hand side, which is basically just showing us that, look, when you adjust for inflation, cash has absolutely destroyed your wealth. And it actually gets worse when you start to go to the high inflation environment. In 2022, we're at minus 10.7. It's clearly not been updated from there. But it just goes to show that ultimately inflation is the key thing that we need to watch out for your wealth. I also quite like the bit on world capitalizations, which is basically just giving us an idea of the general size of global stock markets. And one thing that is notable is that, the UK just makes up about 4% of global markets, the US about 59%. China at 4%. And when you're considering your position as an investor, you've always got to ask the question, is there a specific reason why I'm investing in this market? Is there a specific reason that I'm deviating from the global world capitalization? That is basically the size of the markets on a proportional basis compared to the global markets. Anyway, I know it's a slightly different episode, but I think this could be useful. And I think there are some people in my audience who probably really like the data that would like to have a look at something like that. So just thought it was an extra episode that would be useful. I hope you guys found it helpful. See you next time.